Today I was pleased to release a paper on sovereign wealth funds and pension plan control of Canadian companies and tax implications. Let me explain what I mean by that. Currently, there are certain players or investors in acquisition markets who are able to buy and control Canadian companies on a tax advantage basis. And these are pension plans because they are not taxable, as well as sovereign wealth funds that typically do not pay tax to their governments, although they may pay some withholding taxes that are applied to payments to non-residents. So here's the problem. The important thing of acquisition markets is that we have a competitive market to replace managers when they're not doing as good a job running a company as somebody else who believes that they can do better. And the way that somebody can buy a company is to actually go out and offer a premium to shareholders on the belief that they can actually make more money than the company is currently doing. And what this leads to is a much more dynamic business sector because we do get the best managers running Canadian companies. On the other hand, if there's a non-level playing field where some investors have a tax advantage to buy up Canadian companies, then we can get a mismatch where we're not necessarily getting the best managers operating companies in Canada. And that could be an economic cost to Canadian society. Governments have recognized this in the case of Canadian pension funds. Currently, there is a rule that restricts Canadian pension funds from owning more than 30% of the voting shares of a company. This is a way of trying to put some limitation on pension plans, not in terms of how much money they can invest in companies, but in terms of whether they can get control of companies. That rule is not entirely effective, as there are some ways of getting around it, but it does have some impact. The other implication of this is financial. We actually end up losing some tax revenue because a lot of the corporate income tax can be avoided. In fact, my colleague Vijay Jog and I have estimated in a recent piece that actually this costs Canadian governments $600 to $700 million a year in the case of pension plan control over companies. So there are three possible solutions to this problem of trying to have an even playing field across different types of investors. One solution is just to get rid of the 30% limitation that applies to pension plans. At least this puts sovereign wealth funds and pension plans on the same basis, except sovereign wealth funds will at least pay some tax, as I mentioned earlier on, unlike pension plans that pay no tax at all on any income they receive from the Canadian corporation. The second solution is to tighten up on the 30% rule, not only for pension plans, but also apply it to sovereign wealth funds. And that would at least move it to a more even playing field with taxable investors. The third solution, and the one I really prefer the most, is to actually put a limitation on the deductibility of certain expenses for a corporation when income is being paid to the pension plan or to the sovereign wealth fund that are tax exempt. And this could be a way of preserving the corporate income tax and at the same time ensuring that there's a more level playing field amongst different types of investors. Either way, the government should address this issue, and it's time to level the playing field. I'm Jack Mintz. This is the School of Public Policy, and thanks for watching.